Welcome to this explainer. Okay, let's be real for a second. If your business bookkeeping currently feels like a chaotic shoebox completely stuffed with random receipts, you are in the exact right place. Today, we're going to demystify the absolute foundation of your business finances, the QuickBooks chart of accounts. And don't worry, we're skipping all the heavy accounting jargon. We're just going to focus on practical, actionable steps to structure your accounts so you can actually make confident, profitable decisions. So here is our roadmap for today. First up, your financial filing system. Then we'll look at assets, liabilities, and equity. After that, tracking income and expenses. Fourth, why this account structure actually matters. And finally, number 5, some common mistakes you'll definitely want to avoid.
All right, part 1, your financial filing system. So what exactly is a chart of accounts? It's really just the organized list of accounts that QuickBooks uses to classify your business's financial activity. That's it. Don't let the name intimidate you. It's not some complex calculus. It's simply the vital structure behind all your most important financial reports, like your profit and loss statement and your balance sheet.
I actually love this way of thinking about it. Picture a massive physical filing cabinet sitting right there in the corner of your office. Every single transaction you make gets sorted cleanly into a very specific folder inside that cabinet. When it's organized well, finding exactly what you need is an absolute breeze. Now, every single transaction you put into your software is assigned to one of 5 main drawers. And this explains the full story of your finances, literally where money came from, where it went, what you own, and what you owe. These are the core building blocks of accounting: assets, liabilities, equity, income, and expenses. Moving on to part 2, assets, liabilities, and equity. Let's crack open those first 2 drawers. The easiest way to wrap your head around these is to contrast them side by side. Your assets are the resources you own or control. Think your business checking account, your inventory, maybe your equipment. Liabilities, on the other hand, are what you owe to other people. That's your credit card balances, sales tax payable, and business loans. Put simply, assets are what you have, liabilities are what you owe. Now, this is where a lot of beginners get tripped up. Say you buy a shiny new delivery van. You wouldn't just log that as an ordinary throwaway expense, right? It's an asset that holds real financial value. You own it. By that same token, when a bank drops a business loan into your account, that is absolutely not income you earned. It's a liability because you're on the hook to pay it back. And that brings us to a really beautiful fundamental equation. Assets minus liabilities equals owner's equity. Think of it like this. If you sold off every single asset you own today and paid off every last debt, your equity is the true bottom line financial value that's left over just for you. When you look inside that equity drawer, you're going to see things like owner contributions, owner draws, which are your withdrawals, and retained earnings. The exact terms you use will depend on your legal structure, whether you're a sole proprietorship, an LLC, or an S-corp. But fundamentally, this drawer is all about tracking the owner's skin in the game. Let's dive into part 3, tracking income and expenses. These are the 2 drawers that make up your profit and loss statement. Income is pretty straightforward, right? It tracks the money you earn through your normal, day-to-day business activities, like billing a client for a service or selling a physical product. On the flip side, expenses track the daily costs of operating your business and actually generating that revenue. We're talking rent, advertising, and all those software subscriptions. Listen, here is a massive tip if you're just starting out. Always categorize your expenses by their actual business purpose, not just by the store you went to. If you hit up a big box store and grab some printer paper, that's an office supplies expense. But if you buy a $2,000 computer on that exact same receipt, that is an asset. They belong in completely different folders in your filing cabinet. And like we talked about with loans, never ever assume every single bank deposit is income. Okay, part 4, why account structure matters. So why do we actually care about keeping all this perfectly organized? Well, it's essentially a domino effect of success. A highly organized chart of accounts automatically generates accurate financial statements. And accurate statements, those mean efficient, painless tax preparation. When the setup is right, categorizing transactions is easy, your reports are readable, and tax time becomes an entirely stress-free, streamlined process. Honestly, a proper structure is your best defense. It helps you clearly identify tax-deductible expenses, rigidly separate your personal and business activity, track your loans the right way, and avoid a massive, expensive cleanup job in April. At the end of the day, your chart of accounts should reflect exactly how your business operates while effortlessly giving you the specific info required on your tax returns. And finally, part 5, common mistakes to avoid.
We want to keep that filing cabinet from turning into a junk drawer, right? So keeping things simple is your ultimate goal here. Please do not create a separate account for every single store you visit. Just use a general office supplies account. And whatever you do, fight the urge to dump things into a miscellaneous folder. That black hole completely defeats the entire purpose of having an organized system. You also want to watch out for specific categorization traps. Like we mentioned earlier, do not record a loan payout as income, and definitely don't expense high-value equipment as mere office supplies. Using the wrong account types for these things will drastically skew your financial reports. Imagine actually paying income tax on a loan because you categorized it wrong. That is a fast track to a major headache during an audit. If there's one golden rule to take away, it's this: do not overcomplicate things. Subaccounts are totally fine if you really need a little extra detail, but creating hundreds of them will just overwhelm you and ruin your records. Maintaining a clean, streamlined list is literally the absolute best thing you can do for your business's financial health. I'm going to leave you with this one question to chew on. If tax season started tomorrow morning, what story would your chart of accounts actually tell? Is your filing system ready to go right now? Or is it time to open up those 5 drawers, clear out all that clutter, and finally take control of your numbers? Thanks so much for joining me for this explainer, and happy organizing.